So good evening. My name is Arjun Nair, and welcome to our quarterly webinar on ASK funds. Today we'll be discussing in detail about our flagship, the ASK IEP portfolio, and for that we have Mr. Sumit Jain with us, who is the Deputy CIO of ASK. So Sumit, let me just rack your brain a bit since we last spoke. I mean, the last few months have been fairly active. I mean, you've had the budget in India, you had the US election results with Trump coming to power. You had the RBI rate cuts. Q3 results have come out for Indian corporates. FPI selling has definitely gone up, and hence the volatility that has ensued after that. So, on the backdrop of so many events, I would request if you can just share your views briefly on the broader landscape and spend more time on how our portfolio is specifically IEP's positioned and how we see it going forward. Also, I'd request the participants if you can just type in your questions in the chat box. We will try and get all of them answered. We've already got some questions, which we will let Sumit answer post his commentary. But at the same time, I request to use the chat box and just keep typing questions as and when you want them to be answered. With that, Sumit, we would like to bring you in and hear your views on what we spoke of right now.
Sure. Thanks, everyone. Thank you, everyone, for joining in this call. Ajay, is my voice clear? Should I continue?
Yes, we can hear you.
Sure. So last time when we had this call about 3 months back, then and today, what has changed certainly is the sentiments. Obviously, it's not that beyond sentiment nothing has changed, but there are quite a few things that has happened over last 3 months. But certainly from a extreme sentiment on one side to now we are on a very, very different mood. We are at a point where um, most of the indices have corrected pretty sharply from peak. Your large cap is down 12-13%. BSE 500 would be down about, I would think 15-17%, small cap down about 20% or more. So now it's the question in front of everyone that what next, right? What should one do from here on? Clearly, last 3-4 years have been great for markets. How should we think about things playing out? So what I intend doing in this call is first take you through what I believe would have led to the kind of sentiments that are prevailing at the current point in time. But suffice it to say, um, these are all things that we are trying to understand at the current point. Things keep evolving, and we are always student of Mr. Market. So we'll have to kind of keep understanding many of those things. So we'll take you through what's happening in the market from our lens at the current juncture. How was 2024? Because that and today may be slightly different, but how was 2024 in general for markets as a whole? How should we or how are we positioning our portfolios? And then we'll kind of take you through what has been the IEP actions, performance, psychographics, and all those stuff. So with that, let me kind of take you through the presentation. Can you see the slide?
Yes, Sumit, we can.
Just a second. Sorry, it's can you see the second slide?
We're still on the main slide.
Still on the main slide? Just a second, it's not moving. I don't know why. Give me 2 minutes for this. Just sorry for this inconvenience. Give me a minute. Yeah. Can you see this slide?
Yes, we can.
So with that, let me kind of take you through what's happening in the what has created this kind of chaos. Clearly, we've seen elections in many parts of the world in last year, but certainly after US election, things have started to look slightly difficult for world markets. Uh, this tariff stuff has actually imbibed huge amount of uncertainty in has imbibed a lot of uncertainty. That's one. Second, when we think about domestic economy as well, the growth that was anticipated, there was hope that post-election we should start to see activity kind of picking up. But that pickup actually has been slightly slower than what everybody would have kind of anticipated. And those expectations were not met, right? So to that extent, that created some uncertainty. And also management's commentary in the Q3 results, while has been mixed, my own take is this was slightly better than what I would have thought. Right? We went into election or we went into earnings season slightly more negatively, given the fact that pickup was slightly slower. But there are some pockets where we believe things are kind of starting to get better. So let's move on to, yeah, on the tariffs front, what's happening? Why this kind of impact? Clearly, US is likely to impose reciprocal tariff on partner countries, and this is slated to come up in April 2025. But this has led to fear that what happens to our exports. Our exports to US is close to 17% of total export of our country. So it's not small number, close to about $75 billion, right? But if one think about what's coming out, at least finally, is as a trade between ourselves and US, the thought is to double up our trade, which is close to 220 to $25 billion goods and services put together, develop this by 2030. So clearly, the trade activity between India and US actually should inch up. So that, to our mind, is while shorter term we need to see how things play out, but clearly we both countries are looking to have a relatively larger share of trade. And what does this mean in this backdrop of anti-China sentiment as well? Is there are many businesses with respect to semicon, electronics, pharmaceutical, home textile, refining. Those actually should start to benefit over a period. Um, so if we were to think about how to divide these beneficiaries, clearly there are areas where those companies which have rising presence in India, of those US companies which have rising presence, right, they will benefit because if trades get better, certainly electronics, IT hardware businesses in India should actually see improvement. Then there are sectors that are strategically critical under India-US partnership. We have been talking of technology space, energy space. Those are again very important areas um, from the trade perspective. Then clearly the higher competitive advantage versus China we have in quite a few areas, including pharmaceutical, over period should start to benefit. And also areas where if you think about China, we are seeing relatively higher wage cost, and those where we are kind of starting to get better, including home textiles, should start to see improvement. Um, Over last few weeks, we have seen um, pharmaceutical industry in particular. And why I'm talking pharmaceutical industry? Because we have a reasonably decent exposure in pharma space in the portfolio. That has got impacted is in last few days um, because of all this talk about reciprocal tariffs. But we believe that India is a very large partner to US on the generic space. Of the total generic supplies, India supplies close to about 40 to 50% of the supplies there. So India is large in that sense. So if and can any country replace India at the current prices? Difficult to say that. I don't see that to come up in the short period of time. And if tariffs were to be imposed, it would have burden on the consumers there. Right? So clearly, we believe that pharmaceutical companies actually should not get impacted because of the phenomena that's being talked about. Even if there is a tariff on the pharmaceutical space, we believe that our companies should have ability to pass it on to the consumers there. Effectively, what we are seeing is even in the past regime when prices were low, supplies was going out of the system, right? There were players who were saying that it is not affordable to them at those prices. So clearly, higher tariff would mean a lot more companies actually going out of system, and that would mean those who actually are cost leaders and those who have investment in R&D there, who have product pipeline in place there, should actually start to benefit significantly more. Um, with that, let me take you through the union budget. And I think this is a budget which is a change after a while. For last 4 years, we have been seeing significantly higher investment in capital expenditure in the country. Last 4 years, capex actually grew more than 20%. This budget, we saw very high focus on consumption. Right? Why do I say very high focus on consumption? Clearly, I would term this as consumption bazooka in this budget, wherein incomes up to 12 lakhs for individual filers will be tax-free in a way. Right? So, to that extent, we clearly believe this thing should have very large bearing on um, discretionary consumption, and more so on the urban side, right? Because pretty decent amount of those beneficiaries would be from the urban economy. Um, Along with consumption, capex didn't take a backseat. Capex, while rate of growth has slowed down, we should still see at least double-digit growth in capital expenditure in FY26. While this rate of growth may be slightly lower than what we saw in the past, but really believe that capex is a function of, I mean, this year's capex, FY26 capex will be function of the orders or the projects that have been disbursed, that have been given to the corporates, right? So to that extent, we should over period see continuing capex growth in India. So this budget, we would call this as consumption, capex, and consolidation, the three C's, right? Wherein consumption should accelerate, capex should continue, and all this with very mindful eye on fiscal deficit, right? Fiscal deficit, which is about, or rather in FY25 is expected to be about 4.8, should be very controlled at 4.4, even if our exports get impacted to a certain extent, theoretically, right? If US tariffs impacts our exports, I still believe it should not have bearing on our fiscal deficit by more than 10 to 20 basis point. So we are among very few countries in the world where we are growing well and inflation is under control, and fiscal deficit is also under control. So we believe this budget is more of a measured optimism as compared to what it was in the past. And markets which were just focused on one side of manufacturing, more of capex, we should start to see consumption businesses as well kind of doing well in the marketplace. With that, let me take you through in general how 2024, what are the key events which can have bearing on businesses from a more medium term perspective. Clearly, 2024 was a year of election. Two large economies, certainly India, US, saw election results, and both has changed the way world actually operates. Certainly, US, we've seen how things have played out, and even in India, um, we are clearly seeing focus high on welfare part of the economy as compared to only or very large part of megalomaniac projects that we were seeing. Climatic conditions, clearly this is one area where it has become really erratic. And while at the current juncture, India may start to see food, vegetable inflation going down world over, vegetable and food inflation actually will become very erratic, right? That can have bearing on some amount of spends in future. Logistic cost, given the volatile geopolitical situation, we have seen logistic cost also going down, going for us with respect to textile businesses. Record money raising. India did see huge amount of money raise in 2024. While it looks good, it is also important that we really focus on the end use of this money raising. Um, what this does is we should we need to be very mindful of the businesses that we are investing into, because higher amount of money in balance sheet can mean unrelated diversification or misallocation of capital. And many times in the past, capital misallocation has led to serious amount of value destruction. We need to be very mindful of the kind of businesses that we are investing in from that perspective. As a house, we have always been focused on right management which actually focuses on few areas. We don't like management who are spreading themselves too thin, and which is why this kind of investing, to our mind, actually will start to play far higher importance from here on as compared to what it was over the last 2 3 years. Um, if you look at the returns profile in 2024, we saw sharp divergence. The best performance was by rather small and mid, and then large cap indices were significantly lower in terms of return profile. In first 2 months of this calendar year, we saw exact reverse of what we saw in the last calendar year. So to that extent, we have always been believing that, for a while, we have been believing that we should start to see the divergence that was there starting to kind of go off. For the fiscal year, a lot of this divergence actually has receded. What are the sectors that did well in 2024? Key among them actually were energy transition, circular economy, electronic manufacturing. Really believe these are areas where we should continue to see long-term investments playing out, and they are pretty longer-term theme, not only in India, globally as well. There is a very high focus on the environment, energy transition, green hydrogen, renewable power. All these are investments that should take place for a significantly longer period of time. We need to focus, while at the same time, supplies side will also start to catch up. We need to focus on those businesses where there is significant amount of technology element that's there. That will be a key to making money in this area, because supplies would catch up. Very few now would start to differentiate themselves, even though this is a very growth environment, right? Electronic manufacturing, certainly this is a large area where India is very clear that we need to reduce our import dependence. If you think about mobile phones as well, from a big importer, we are now a decent exporter already. New age technology, hospitality are areas where clearly there is huge amount of focus. If you think about hospitality or tourism and think about the Mahakumbh thing as well, I mean, the kind of tourism that we are seeing is mind-boggling numbers, right? So we really believe that tourism, whether it is leisure, spiritual, corporate, even medical tourism, these are areas that should do well. That effectively would mean the entire ecosystem of hotels, entire ecosystem of aviation, travel agents should actually do well. With this, let me take you through how has the performance of Indian market been. And very interestingly, for a while, Indian market has been one of the best performing market, not only in local currency terms, but in USD terms as well. But with the recent fall, Indian market is now no more on a 1 year basis, one of the best performers, right? Having said that, we believe this is more of a temporary phenomena. Earnings growth, while this year has been slightly subdued, but really believe that FY26 our earnings growth should start to inch up. FII flows, most of the emerging markets actually saw significantly large outflows, especially after October, right? So this is one phenomena where there has been huge outflows, and India has been no different. Just the difference is India's outflows has been significantly larger in absolute terms, but we need to equate this with the size of markets as well. Indian markets in general have been significantly bigger as compared to many of these large economies. Equity flows in India, there have not been many instances where we saw on a calendar year basis, we saw FIIs pulling out money. If you look at these numbers for last 17, 18 years, there have not been many instances, right? The biggest outflow was at that, if I were to ignore so far this calendar year, the biggest outflow was in CY 2008 at about $13 billion, right? So while we have seen outflows, I think it's only a matter of time that they kind of start to stabilize. Where are the opportunities? That's the key, right? Uh, Last few years, our earnings growth was 20% plus. This year is going to be um, mid-single digit kind of earnings growth. Next year, we should be mid-teens kind of earnings growth. So we are back to, I would say, over medium term, more of mid-teens kind of earnings growth rather than 20s that we used to see. So what will happen to our mind is as earnings growth for India incorporate moderates, the premium for growth actually will sustain. We as a house will avoid cigar butts. We don't want to look for businesses where growth rates are significantly lower, because we believe that it's growth in earnings, growth in cash flows, and the sustainability of these cash flows actually create value over a long period of time. Last year was a year where we saw huge divergence in earnings between earnings and value creation, both between large, mid, and small. We are already starting to see this divergence kind of going off. Small cap in general, while this is generalizing too much, we really believe that investing is bottom up into high quality businesses. But small cap as a pack for last 2 quarters actually saw negative earnings. So this is something which is a sign of worry. Mid caps continue to kind of, at an aggregate level, kind of deliver a decent set of earnings. Where are the opportunities we just discussed? We believe that discretionary consumption, infra engineering, healthcare, these are areas where we believe opportunity for long-term value creation lies. But in an environment like this, when growth rates are more anemic, markets are, to our mind, markets will start to differentiate those businesses which perform versus those that don't. Style of investing has to change from more top-down to more bottom-up. And we believe that we are back to 101 of investing, where quality of management, quality of business actually will start to make significant difference in value creation in those businesses versus the others. This too has to be backed by very stable, long period earnings growth. I think we are back to that era. What are the sectors that we are avoiding, continuing to avoid? We have had a significantly lower weight in those businesses. Banking and IT, we continue to have a relatively lesser weight. With that, let me take you through some of the actions. How has the performance of portfolio companies been? What do we anticipate things, from IIP portfolio? So this slide talks about how has IIP in terms of IIP portfolio in terms of corporate performance been in Q3, and what do we anticipate? So IIP revenue growth was 17%, significantly superior as compared to what it is for Nifty 50 or NSE 500. We've taken NSE 500 this time because some of the companies, there isn't too much of a difference between BSE 500 and NSE 500. PAT, rather than PAT, if you think about operating profit growth, it has been 20%, significantly higher for our portfolio versus what it is for Nifty 50 or NSE 500. The growth between PAT and operating profit growth is slightly lower because what has happened is, in few cases, for example, Indigo or for other businesses, we've seen some one-time hits with respect to Forex and all those, which we don't anticipate to kind of recur next year. So this conversion is something that we will actually see pretty decently next year. Conversion from operating profit growth to PAT growth. So which is why if you think about FY26, our operating profit growth is 22, expectation is 22%, while PAT growth expectation is 26%. But what is more important is the rate at which our businesses are growing from revenue perspective. Huge difference, right? And if you think about full year FY25 and FY26, the gap between our portfolio, our profit estimates versus Nifty profit estimate, that is widening. In the past, this gap wasn't there because in general, India Incorporate also grew pretty fast. Many of those businesses actually reported sharp improvement in margins as well. I think a lot of that phase is behind. We are now growing perceptibly faster than what it is for India Incorporate and Nifty 50. If you look at FY25, we should be about 9 percentage point higher, and it should be about similar 9-10 percentage point higher in FY26 as well. And this is should lead to significantly lesser volatility in our portfolios as well. What are the actions have we taken in IEP portfolio? I would say what we have done is we have bought smaller weight of relatively more number of mid-cap companies as compared to what we used to be in the past. Many of these offer great opportunities from value creation perspective a long period of time. But each of these would be 1.5% weight in the portfolio. So to that extent, they are relatively smaller weight. So we have incorporated Gravita in the portfolio. Gravita is a very interesting, I would say, play on circular economy. We really believe that circular economy will be growing significantly faster, and that's the largest play on circular economy in the country. InfoEdge is a very interesting opportunity. Obviously, bulk of the value creation for InfoEdge comes from Naukri, and they do have some investments in, or rather, they are also a private equity in a sense, wherein they keep investing into many startups. Some of those successful startups certainly clearly were Zomato and Policy Bazaar, and some of those will over period will see new rather value creation from some of their other investments as well. But clearly, bulk of the value comes from Naukri, and what we are seeing in India at the current juncture is if you think about IT business itself, IT business contributes about 50% by and large to InfoEdge Naukri business portfolio. And we are already starting to see total employee count kind of increasing by the industry as a whole, or rather top 5-7 players. And we are also seeing a lot more global capability centers coming into the country. So job environment in the IT space actually should get better. So to that extent, we should see Naukri's growth continuing at a pretty decent pace over the next few years. Then we have got into electronic manufacturing space between Amber and Dixon. Both are pretty interesting plays in their own ways. Dixon is a prima donna player in, I would say, mobile phones at the current juncture. Over period, what we would see is value creation coming from doing backward integration into mobile phones, and also laptop can become significantly larger for the country, for the company. And Amber is a company wherein while profits may not look large at the current juncture, but investments have already been made by the company, and consequently, as we start to see utilization taking place, we'll see very rapid growth in the profits in for the company. Polymedicare, it's a company today with about 20,000 crore market cap. Very interesting play on the medical consumable space in the country. We as a country import huge amount of medical consumables. And over period, very confident that this import content actually will start to go down. Polymedicare is a play on that, and also they have built a very interesting export business. Today, exports are close to about 65% of their business, and more in the half of that business actually comes from Europe. So we believe exports will continue to grow, and domestic import substitution would mean that their domestic business also grows really well. Solar industries is a play on the largest, I would say, explosives player in the country. Has grown really well over last many years. They are now morphing from pure explosives to defense play as well. Right? So these have been the actions in the portfolio that we have taken, and obviously we kind of incorporated this by trimming some of our holdings, and also we exited out of Titan from the portfolio. How does the portfolio psychographics look like? We continue to remain pretty decently overweight on consumption, but our consumption is more on discretionary side. We don't have too much of staples. Even our staples actually is growing relatively faster. Right? So we continue to remain pretty decently overweight on the consumption space. Telecom is one area where we have taken some money off the table after great performance of Bharti Airtel. In the portfolio, we had Bharti Airtel and Bharti Airtel PP. So we trimmed some holding there. Healthcare, we have increased our exposure there. Right? As you can see, Polymedicare is part of the healthcare portfolio, and clearly we have the entire spectrum of the ecosystem, which is international pharma, domestic pharma, APIs, and I would say medical consumables. We also increased exposure in manufacturing in India. Automobile OEM is something Bajaj Auto, we kind of incorporated that in our portfolio. Metal and mining is nothing but Gravita, and recruitment services is nothing but InfoEdge. So overall, if you look at our portfolios, very solid quality in terms of management, in terms of growth. And I think we are at a point where worst of the relative performance should be behind. We already started to see some big changes there. But why are those changes visible? Because if you think about quality, ROCs remain pretty solid, earnings growth significantly superior, balance sheet remains debt-free. If you look at debt equity ratio of the portfolio as a whole, 0.2, it's pretty great number. How does the performance look like? If you look at performance on a quarterly basis, quarter 2 was a quarter where we actually did better than the markets. Quarter 4, so far we again, I mean, when volatility has increased, we have started to see outperformance in the portfolio. I believe, given the way we are seeing some slowdown in the marketplace in terms of earnings growth, volatility in markets which has increased should mean that not only our portfolios should perform well, our outperformance journey, which wasn't there for a while, should start to come up pretty decently well. So I'll stop here, Ajay. I'm open to questions, whatever questions that have come by.
Thanks, Sumit. Thanks for the detailed overview. I think you covered the budget fairly well, recap of last year, and as well as the IP portfolio. Now, actually, we can move to the second part of the call. We'll involve the audience members and try and get the questions. We already have multiple questions coming in the chat box, as you can see. So maybe let me start with the first question. Although you covered this a bit, post the recent budget, we've seen the realignment of tax in the new regime. And sentiment towards consumption as a theme actually has become fairly strong. In light of that, are we planning to make any changes to the portfolio towards consumption, or do you feel the current portfolio captures the trend fair enough? I mean, would we take advantage of that?
So, the recent budget accelerates the trend in the consumption. We have always been, for a while, we have been having significantly higher weight in consumption, right? If you look at the trend itself, we have been significantly overweight. Just because of budget, are we changing our stance? Not really. Clearly, we are looking for businesses that actually will start to see improvement. We already have a decent weight. We'll keep calibrating that weight if required. But I would think that rural has already started to see some revival. Most of the commentaries from the corporate performance that we have heard is rural is slightly better than urban. And I believe urban is also a matter of time that we should start to see improvement there, right? So clearly consumption should improve, but within consumption, we don't intend focusing too much on staples. Staples is one area where we believe that rate of growth will still be just about average over a long period of time. We would look for businesses where there is significant underpenetration in the categories. We would look for categories where there is scope of premiumization, right? And look for businesses where those businesses have ability to increase their market share in those categories. So hopefully, superior volume growth backed by I would say premiumization, and those businesses kind of increasing market share. So that's the template that we would like to follow.
Understood. But there's a follow-up question as well on top of this, saying that, again, although budget might be a very short-term phenomena, the growth in CapEx was much smaller than what was anticipated by the markets. And actually, we've seen a significant, a fair correction coming in spaces across capital goods, infra. So, there are investors asking for views on a few stocks like an Adani Port, or JSW, or KEI, specifically, on how we view them as businesses in the current scope.
So I really believe the kind of slower capex that we are seeing this year is more from the government side. We actually would start to see private capex, not in all areas, but some of the areas starting to inch up. Many of the corporates are still talking of increasing their capital expenditure activity. Right? So if you think about our investments, or rather, what are the areas where there has been slowdown? Which those are areas where there is significant government support, right? So if you think about roads, if you think about railways, if you think about some of those areas, there is a relatively lesser rate of growth. But if you look at our investments, whether it is Adani Port or JSW Infra or KEI or Polycab, each of them are very broad-based, not dependent on few activities in the country, right? So if manufacturing in India were to do well, port activity actually will improve, right? Similarly, cables are very broad-based play on the capex activity in the country. So to that extent, we have not gone very specific with respect to sectors. Yes, solar is a play on defense and explosives in the country, but it's a small play for us. We recently bought in solar when stock prices corrected. So to that extent, we are our capex or manufacturing is very broad based, right? If you think about other manufacturing plays that we have invested into, those are more EMS variety, where we should see 30, 40, 50% growth in profits in those businesses.
Got it. Thanks, Sumit. The next question is more again on the recent entrants in the portfolio. Names like a Solar, Amber, Apar, Polymed, InfoEdge. When you spoke about growth as well and how the IP portfolio should be able to show significant growth versus the broader market. However, the question is also talking about valuations of these companies. So when you talk about future growth, is the current valuation already discounting that in the growth? And maybe we've seen some correction as well coming in a few of these names. Just want to understand your view there.
So if you look at it, we have recently got into those names. Many names have corrected and we have kind of got into those names later. Right? Also, we'll keep kind of looking at what are the relative choices that we have, right, with respect to our investments. And many of these after corrections have become a lot more attractive. If you think about Apar Industries, at about 25,000 crore market cap now, it's close to about 30 times trailing, 32 times trailing. So pretty attractive, and really believe that after a slow patch this year, we should start to see profit growth resuming. Similarly, if you think about Dixon as well, business growth remains very solid. At now at about, I mean, we bought at 15,000 rupee at 50 times 2 years forward with a business with the growth rates which are significantly faster, ROCs which are way superior than anybody else. I think that's a fair price to pay. We are people who would say a good quality business growing really well, if available at fair valuation, that's a much better proposition than buying a business which is relatively weaker in terms of quality, but far attractive valuation. To us, we believe that quality of business, quality of management makes a significantly higher difference in value creation over a long period of time. And that shows up when times are relatively more volatile.
Can I assume by that commentary that we might take advantage of this correction over a period of time? I mean, we might increase weightage a bit across these names that you added right now.
This is
Would
what
there be a
we've done.
realignment?
This is what we've done as well in last few days.
Excellent. Again, although this question has been asked of you multiple times now, is that, earlier, if I look at IP portfolio, maybe 18 odd months back, we used to about 20, 22 stocks in the portfolio. And now the number of stocks have increased. We're touching, approximately 30 odd names in the portfolio. Has there been a change in the overall approach? What is the thought process? We've covered that maybe in the past, but just want to understand your thoughts again on this.
So today we have slightly more than 30 names. Eventually we'll go around 30 names. What we've done is we have bought smaller position of some high quality businesses wherein liquidity may be low because we are always very mindful of what is the liquidity profile of the stock. Right? At no point we would like to make our portfolios illiquid. So that's one. And second, even in those when those businesses, while we believe that growth rates are going to be significantly high over next many years, we'll kind of keep evaluating, and appropriately we may increase weight in few over period. But clearly, if you look at this portfolio a year back, this would have been 25 stock portfolio. This is now 30. We should be about this number over period now.
Got it. Got it. Thanks for that, Sumit. Another, more from a sector perspective, is that if you look at sectors like, from valuation standpoint, also looks comfortable for the market, banking, and maybe clubbing a few more questions on being underweight on banking and IT as a couple of sectors overall. Want to understand your view. So we don't have any bank in the portfolio. We just only have TCS as an exposure. That was slightly smaller one.
Talking banks or IT?
So we're completely underweight on bank and IT versus
Correct.
the markets,
Correct.
hardly having exposure in IT, and again, no exposure on banks. Just want to understand your views on these two spaces and your thoughts in both.
So in case of lending, we are more focused on NBFCs as compared to banks. High quality NBFC who understands his customer well. And by the way, that positioning has helped us. If you look at our exposures of Bajaj Finance or Cholamandalam Finance, they have done after a significant consolidation for a while. We have seen decent performance in the last few months by them. While business performance continued to remain pretty interesting. Really believe that both these institutions should grow significantly faster than credit growth with the above average ROE and valuations that are a lot more interesting. Coming to banks per se, yes, optically they are cheap from a valuation perspective. But this cheapness is also in an environment where credit growth should remain at about 10-11% over medium term or 12% at best. And so most of these banks which have got solid balance sheets should grow 12, 13, 14% at best. And even ROEs which are plus minus 15%, right? Give or take something. So these are now turning out to be average growth, average ROE businesses. We believe that there are opportunities in other areas in the lending or the BFSI space where decent amount of value creation can happen, and which is why we have relatively higher weights towards NBFCs. And also, in an environment where interest rates are expected possibly should go down, NBFCs are relatively better placed from a NIMS perspective as compared to banks. So, which is why we have had an overweight position in banks in NBFCs as compared to banks. Coming to IT, see, most of these software services businesses, to our mind, should over long period grow high single digit in the local in constant currency terms. And currency depreciation adds on to their revenue growth. Even the currency depreciation, while in the short period improves margins, but over period, what we've seen is the benefit of currency depreciation gets passed on to the consumer. So long period growth in software services businesses should remain high single digit, low double digit in that order. So if you look at our exposure, we have TCS, we have Apple, we have, in a way, when IT companies do well, clearly Info Edge will also do well. So those are, so we don't have software services per se as much, but more of a product advertisement technology company, which is Apple, or Info Edge, which is in a way also a platform.
Interesting. Yeah, so again, the question in terms of what you had spoken of, so you spoke about the Q3 results, and you've shown how the portfolio is done even in Q3 versus Nifty and NSE 500. So we do see a divergence versus broader markets supporting the IP portfolio. So what do you think? I mean, the question is that we are talking about the divergence finally supporting IP versus the markets on paper, but what do you think will lead to the portfolio doing much better, or where do you see the growth really coming from for the portfolio?
So if you, let's look at FY24. FY24, BSE 500 did 40%, our portfolio was 30 to 33% in terms of returns. In absolute sense, that was a decent performance from a returns perspective, right? What was happening was our growth rates were continuing at around 20% plus, while markets was also around 20% or slightly better. Right? Now we are coming to a point where our growth rates remain there, but market growth rates are kind of starting to go down. So on a relative scale, the divergence has started to show up, and this will should show up in the value creation as well over period. At all points, we have always focused on ROCs that have, if you look at our portfolios, ROCs remained at 30% plus throughout. So focus on ROC remained high in the past and even now. It's just the earnings divergence, which is kind of improving or rather increasing versus what the growth of India Incorporate would be. And that gives us confidence that on a relative scale, our portfolios should do much better.
So interesting what you mentioned about broader market earnings as well. Again, a question which was there. So maybe let me cover that right now only. So when we saw the broader markets do well in terms of equity performance, the underlying earnings was also strong for the broader markets. And in the current context, I think that earnings has really tapered off from the indices. So the correction might, I mean, one of the reasons for the correction can also be, given to the fact that you've seen earnings really come off, and hence there has been a bit of a call to take money off the table. And again, the thought which is coming from the question is that with this divergence, we do anticipate that IP will have the differential versus the markets, and hence performance should be reasonably better than the benchmark. Is the right assumption?
Let me put it like this. Earnings growth is just one. Markets also got impacted because of multiple factors that have played out in India and globally, right? Where US Trump tariff created some negative sentiments. FII outflows created negative sentiment. All those meant that the impact on markets actually was pretty sharp, right? And you know what happens is my own experience has been that whenever there has been volatility, high quality businesses which are consistently performing in the marketplace, they do well, right? So you know whether this volatility will remain or will it go away in the short period of time, I don't want to comment on that. Um, we are very confident that our businesses have large opportunity size. The growth rates are relatively more sustainable. And not only are these growth rates sustainable, they will be delivered in our assessment with superior capital efficiency, and obviously then what would follow is a very superior cash flow growth. And that gives us confidence that we should deliver performance over medium term.
I think while you were answering, there's a question which also came in specific to what you're speaking is that although revenue and profit growths seem to be fairly superior, the drop in portfolio value has been similar to Nifty or BSE 500 for the matter. I just want to understand what the reasons would be for this. And maybe if you can also cover that how we've seen the correction in the recent past, how has the portfolios really behaved?
So if you look at drop in this calendar year, we have actually fallen less than the benchmark. From the highs, possibly we may have corrected similarly, right, from around September till today. But you know, some of our businesses got impacted temporarily, but very confident given the way businesses have performed in real life, they should come back. For example, if you think about Interglobe Aviation, Cholamandalam Finance, right? They corrected when markets also corrected in the month of October. Right? If you think about TVS Motors, right? Each of these businesses corrected at least 20%, right? And consequently, from the highs, it looks like that we have almost corrected similar to what the benchmark is. But the recent volatility, we have fallen significantly. We have fallen less, and now that Q3 results are coming out, the difference is kind of starting to show up.
Thanks, Sumit. You spoke about growth as well. In times of volatility, and especially times like these, how do we ensure that, and you spoke about valuations, how do we ensure that, as per us, it might be a fair valuation, but we're not buying into something which is overly expensive? Any process that's been set at our end, how do we ensure that we don't make mistakes on the valuation front?
Okay. So before I come to valuation, I think what is important is valuations certainly are important, but what is also important is we don't kind of make error of commission. We don't get into businesses where qualitatively those are not great. Or management kind of get into areas which are so we have to be very focused on the quality of management and quality of business. That comes first. So we are very focused on how do we avoid those mistakes. Right? In the last decade and a half of managing IoT portfolio, I would say that we have really avoided mistakes of these variety. With respect to valuations, if these businesses are growing fast enough for a significantly longer period of time, and if I'm not making very grave mistakes on valuation over period, those mismatch can get corrected. But suffice it to say, we don't intend making those mistakes as well. Very highly focused on right character at an appropriate pricing.
Got it. Got it, Sumit. Again, a question coming in is that in terms of what you mentioned about divergence earnings, do you believe quality businesses will command greater multiples, leading to the IP outcomes? A P re-rating for forgotten quality blue chips? Question mark.
Sorry, PE re-rating?
For forgotten quality blue chips.
So see, what is quality? I mean, that's an important question, right? To our mind, quality is right management, right business, sustained growth, superior capital efficiency. Um, it's not just that because it is a blue chip, it's a large cap, it necessarily is a quality, right? So that's the way we define quality. And if you look at markets on a 5 or 10 year basis, certainly this consistency actually delivers value. So that's the way we would like to define quality rather than size. For us, size is immaterial. It's the ability of management to deliver sustained, I would say, growth in profits in an environment where whether it is good or bad, that we would like to term quality actually.
Right. A fairly generic question which has come in right now. Is it a good time to increase equity allocation? And let me maybe add something further on top of that. Do you think it makes sense to add funds to IEP portfolio right now in a does it make sense to add funds? Second is that how should we add the funds? I mean, should we lump sum or should we do an STP route?
So, see, this always remains a very difficult question that if one is looking to invest, should he invest lump sum or through STP, right? Because markets by their nature will remain volatile. And our ability to really predict that this is the bottom, I don't think we have that ability. Neither we want to get into those. We would deliver alpha over long period by our stock selection skill set. And given the fact that um, the growth rates in India will be certainly way superior as compared to many parts of the world. 6.5% growth rates um, with about, let's say, 4% inflation. So let's say double-digit nominal GDP. If we were to kind of, as a country, maintain that for a long period, Indian markets will clearly deliver value, right? So should one increase equity allocation when there is a lot of uncertainty? Certainly yes, because when there is uncertainty, you get relatively better risk-adjusted return. But does it mean that prices can't go lower from here on in the short period of time? I'm not equipped to answer that because markets will continue to remain volatile. Volatility is actually a friend of um, investors who are looking to invest, who are looking to create long-term portfolios.
Understood. As per you, again, a question with regards to the recent correction that we've seen. Which would be the top holdings where the future earnings seems fairly bright and the valuations also seem very attractive within the portfolio? Maybe 4 or 5 names which you think make sense, or you want to say that generally overall looks fairly okay?
No, I'll be doing injustice if I talk about 3, 4, 5 names. Uh, I have reasonably high confidence in most of the portfolio companies uh, that are part of the portfolio. I mean, think about it. We have been owning Interglobe Aviation for a while, and we continue to remain pretty positive even now. Circular economy gravita, we remain reasonably confident that it should kind of continue to grow at a fairly rapid pace for a significantly longer period. And the way industry is evolving, right? Even the NBFCs that we own have continued to grow well and should continue to report that kind of growth rates, right? So, I would think most of our portfolios, we are very comfortable with respect to their business performance delivery.
Got it, Sumit. Uh, so broadly, we covered all the questions that were answers. If I can just do a quick recap. So you mentioned that the broader growth which was happening for the markets across the entire spectrum in terms of profitability, in terms of revenues, has started to taper off. And it's become a lot more critical that we become more bottom up, very, very stock specific in the current scenario. And in times like these, it's important to focus towards growth and quality of that growth at the same time with reasonable valuation, which we might be getting right now within the portfolio. So IEP, as per you, is very, very favorably positioned, right, Sumit?
Certainly.
Covering all these aspects.
Because we have always focused on those basics of those businesses, characteristics of those businesses. While when markets were in a very euphoric phase, we may not have delivered as great returns as what markets have delivered, but pretty confident that the positioning of these businesses actually gives us confidence that this is a portfolio that would deliver.
So thanks again, Sumit. Thanks for your views. I think you covered the budget very well. You covered the portfolio stocks very well. And I sincerely hope that the journey for our investors becomes a lot more smoother going forward. I thank all the members who participated in today's call, and I sincerely hope again that the discussion we were able to really add some value to all of you, and we were able to answer most of the queries that were asked. Thank you once again, and that concludes the session for the day. Thanks.
Thank you. Thanks a lot for participating. Thank you.